and they can join for the another round of questions. Thanks, and over to you, sir.
Thank you, Anirudh. This is Jitendra. And welcome to everyone who has joined us in this call. I know it may be a weekend for certain people, but we all work nowadays longer. So thanks once again for everybody to join. As we begin, I would start by saying that the financial year 24 began on a subdued note with high inflation and concerns on slowing of economic growth and poor health of banking sector. Policy tightening by central banks in response to this inflation continues to raise the borrowing costs, leading to constrained economic activity. While inflation may continue to remain high, it may further escalate owing to shocks posed by geopolitical unrest, natural calamities within various parts of the globe. This, in turn, may trigger a more restrictive monetary policy. Concerns regarding the performance of banking sector receded during the quarter, but high interest rates filtering through the financial system trimmed the supply of credit. The rise in central bank policy rates to fight inflation would continue to impact economic activity. As per IMF, global growth is anticipated to fall from an estimated 3.5% in 2022 to 3% in 2023. While economies across the world are facing issues, the Indian economy has shown resilience and grown during the quarter. The centre's fiscal deficit remained under control. GST collections, manufacturing PMI, sale of automobiles, number of UPI transactions, electricity consumption, all reported strong numbers during the quarter. The resumption of interest by FPIs in the equity market showed a good infusion of funds, raising the indices to a record high. The Indian economy does not seem to dither the concerns on the inflation, primarily driven by rise in crude oil prices and food inflation. The USD INR, however, continues to remain under pressure, moving to the upper end of range rupees 83, owing to the rise in yields due to US credit downgrade and other macroeconomic factors that may lead to higher import costs, impacting the overall growth. Given the overall business backdrop this quarter for us at Voltas, it was both exciting and challenging. The incessant rains impacted the sales during the quarter and thereby slowed down the anticipated growth in the cooling business segment, both for the company and the industry. Delayed collections in our overseas business resulted in a conservative provision impacting the overall result. Our consolidated total income for Q1 FY24 was rupees 3,430 crores as against rupees 2,795 crores in Q1 FY23, a growth of 23% year-on-year. Profit before tax, PBT, and after tax was rupees 203 crores and rupees 160 crores respectively. Earnings per share, not annualized, for the quarter ended 30th June 2023 was at rupees 3.91 against rupees 3.29 reported last year. You all have seen the snapshot of our results for this quarter, therefore I'm not repeating that. However, we're looking at segment A, Unitary Cooling Products, UCP. Q1 of FY24 was projected to be a high growth quarter. However, erratic weather conditions in April and May, especially in North and West India, our usually stronger markets, dampened the spirits. However, availability of high tonnage products, aggressive consumer finance schemes, strong channel and network presence, coupled with revival of the demand in the month of June, helped Voltas achieve volume growth of 15%, higher than the overall industry growth on YOY basis. Voltas' product bouquet with advanced features and long-term advantage of energy savings helped the split inverter category of air conditioners remain in high demand, leading to the growth for the segment. The expansive product portfolio, SKUs designed in-house, and competitive pricing has continued to have a high share of contribution in excess of 80% of inverter sales in room air conditioner category for the quarter. While split AC showed the growth, demand for Windows AC, primarily driven by sales in North, remained weak because of the unseasonal rain. Our competitors went aggressive on the pricing to meet their primary billing, which impacted market share and margins. However, secondary sales driven by incentive schemes across sales channels, healthy tie-ups with modern trade and organized channels, growing network of exclusive brand outlets or EBOs, including experience zones at strategic locations, along with a focused customer-centric approach during the season.
Growing network of exclusive brand outlets, EBOs, including experience zones at strategic locations, along with a focused customer-centric approach during the season, helped Voltas to strengthen market share to 20.6% at the end of June 2022. Sales growth in the commercial refrigeration was lower during the quarter on a higher base of the corresponding previous quarter. Weather disruptions had impacted the consumption of cold beverages, chocolates and ice creams, leading to the lower than expected demand from the OEMs. Within the commercial refrigeration category, demand was buoyant for water coolers and easy coolers. Affordable pricing tie-ups with modern and retail channels, active channel participation, aggressive pricing with lucrative dealer incentive schemes garnered a positive and a strong growth for the air cooler segment as well. The category has grown by 49% in volume with improved gross margin. Commercial air conditioners garnered good traction in chillers, VRFs, and cassette AC during the quarter, with large-scale O&M orders paving the way for good numbers this quarter. Our focus on customer needs and our track record has helped us win multiple big-ticket orders for O&M. On the cost front, softening of commodity prices, tactical sourcing, manufacturing efficiencies, and various value engineering initiatives across all our products has helped contain material costs and protected margins to a great extent. We will continue with our efforts to remain competitive and continue to provide value for money products to our consumers, which will help us not only to maintain our leadership position in both the market share and margins, but also continue to be a key differentiator among other players in the industry. To summarize, for the quarter ended June 2023, UCP segment registered revenue of rupees 2,514 crores, a 16% growth in turnover from rupees 2,162 crores in Q1 FY23. The segment reported an EBIT of rupees 207 crores in Q1 FY23 as compared to rupees 166 crores in Q1 FY23, a growth of 25%. Segment B, Electromechanical Projects and Services. Segment revenue for the quarter was rupees 679 crores as compared to the previous corresponding quarter revenue of rupees 455 crores. Segment results for the quarter reported a loss of rupees 52 crores. Loss in quarter ended June 2022 was rupees 12 crores. With renewed focus on our wholly owned subsidiary post-business transfer, our collective efforts resulted in better performance of the domestic projects business in terms of both execution and managing working capital efficiently, and also securing healthy orders during the quarter. The domestic projects segment booked orders worth rupees 608 crores as compared to rupees 191 crores during the previous quarter. Further, a tight monitoring on working capital with focus on certification and collections in return on capital employed and delivered good results during the quarter. All ongoing projects in our international business are largely under nascent stages, and while the business reported a higher revenue, as per our internal policy, the margins on all such projects will be recognized on reaching key milestones. Considerable delay in certification and slowing collections against due receivables continued in a few projects, resulting in provisions following our prudent and conservative approach. Having said that, all efforts are focused on engaging with customers for expediting certification work and improving collections of the amounts due. Order booking for Q1 FY24 was rupees 755 crores as compared to rupees 435 crores in the similar period last year. During the quarter, the company has been intimated of a request received by the bank for encashment of the bank guarantee from the main contractor in one of the projects in Qatar. The company has issued a cessation request to the bank, pursuant to which the bank guarantees have not yet been encashed. This is internal assessment on technical merits of the case and legal opinion on the contractual aspect. We are confident that it has good grounds to successfully defend any claims that may arise on the company. The carry-forward order book for domestic projects stands at rupees 5,244 crores, containing orders across water, HVAC, rural electrification, and urban infra activities. The international order book as at 30th June 2023 stood at rupees 2,949 crores, largely in the UAE, Qatar, and Saudi Arabia regions. Total carry-forward order book of the segment stood at rupees 8,193 crores, vis-a-vis rupees 5,362 crores of outstanding orders as at 30th June 2022. Segment C, Engineering Products and Services. The segment revenue and results continued to report improved performance for the quarter, registering healthy growth over previous year. The segment revenue for the quarter was rupees 142 crores and EBIT for the quarter was rupees 54 crores respectively. Cutting-edge engineering solutions coupled with a focused customer-oriented approach supported Mozambique operations in performing well, contributing significantly to the results. The revival of the capital cycle, along with lifting of export duty on iron ore, has sustained the sale of crushing and screening equipment, albeit with restricted credit to the contractors. While capital machinery rollout from the principal has increased, the volatility in yarn prices and slowing exports, coupled with supply chain disruptions, has lowered the momentum for textile business. Nevertheless, the focus on accessory sale, recent announcement of PM Mitra Park and the proposed PLI 2.0 scheme should help in sustaining the performance going forward. Voltas Beko. Voltas Beko continued to garner strong sales since March 2023. High demand across all company products, that is, refrigerators, washing machines, microwaves, and dishwashers, resulted in a growth of over 40% during the quarter. Revenue was also driven by increased tie-ups with organized retail, improved participation from e-commerce, and a better product mix. The expansion of distribution reach, focus on product placements with existing and evolving sales channels, wider range of product SKUs, and in-house manufacturing of the high value-added products continue to support the overall growth. Timely availability of affordable and durable products has been the key strength for Voltas Beko. Our concentrated efforts on innovation with differentiated features and long-term tie-ups with organized trade in the targeted and strategically important markets is anticipated to further support our growth in future. These collaborative steps have resulted in securing a market share of 5% in the washing machine category, with 9.6% market share in the sub-segment of semi-automatic washing machines. The company also maintained its market share in refrigerators at 3.5%. Our objective is to have a vast array of value-added products which will be manufactured at our own factory, which will help us control and thereby strengthen the supply chain to improve overall margins. With this objective, trials for the fully automatic front-loaded washing machine to be manufactured in-house have been completed, and the production of the first pilot batch is underway currently. Outlook. The period of July to September is usually a lean period for cooling products. However, the start of festival period is expected to witness a spurt in demand. It will be interesting to see the impact of factors such as inflation, revival of rural demand, movement in crude oil prices, rupee behavior, and policies made by RBI to address the overall economic growth agenda. Both the government and private sector's capex commitment for FY24 remains strong. Uptick in the order booking coupled with momentum in execution of the MEP projects should help report better performance for our project businesses too. In general, we anticipate a pickup in the pace of overall economic activity, and we would seize the opportunity to continue on the momentum of growth. That's all from my side, and I would now request the moderator to open the meeting for question answers. Thanks.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Ankur from HDFC Life. Please go ahead.
Yeah, hi sir, good afternoon. Thanks for your time as always. Just a few questions on the UCP segment. So very good performance, the 15% volume growth that we're seeing. But just if you could help us understand, because industry volumes were maybe flattish, on the secondary side during the quarter. So if you could help us understand, how would our secondaries have done during Q1, and is it also a case of, us kind of filling in inventory in the channel? Is that the reason why our primaries look so much higher than maybe what the overall secondary growth would have been?
So Ankur, this is Manish over here.
Sure.
Ankur, in fact, the question of higher primary and the inventory with channel partner probably won't material, because if the inventory is there with the channel partner, obviously it will see a reverse impact on the primary sales from the brand. So what is happening is, although we all know North region, which is strongest for the air conditioner market and contributing larger share in the overall, that didn't go well. And if I look from the Voltas perspective, we are relatively stronger, as you all know, in the North region. So in a way, in the initial months of the quarter, we were having a lot of apprehension on the volume and the growth. The reason being is because industry was not looking into a volume growth at all in this quarter because of this inclement weather. However, you recall that we have taken some steps in the South market to strengthen our market share, which were continuously on a weak foot. That actually has resulted us, because what we have seen in our trend, that we have, if I look from my primary perspective, and generally secondary also follows the primary, our volume growth for both East and South was on a much higher side, followed by North, because North we all know that the growth was marginal. So in and all, I would like to say that the strategy or the focus what we did in the past 2-3 quarters, since I would say last year, to make our position stronger in South region, actually started getting some kind of momentum. But I'll be saying it is not it will be too early to celebrate on this front, because what we need to ensure now that we sustain this momentum in South, winning the confidence of the channel partners and customers both, and should further strengthen our position as we move forward. Similar steps have helped us in moving in the East region as well, where we have relatively performed much better than any of the brand.
As I said, we will continue to do a monitor on our steps and our strategies in these two regions to further strengthen our positions. Not anyway going to be a strong foothold in Voltas as well as for the overall industry, and will not leave our footage or our leave not any stone unturned if I were to further aggressively move on the north when the market becomes more open for the cooling product categories.
No, fair point. No, I just want to reconcile the fact that, our volume growth of 15%, how would that have been versus the industry growth? Given the fact that our market share numbers, both Q1Q and YOY seem to be lower, right, for Voltas. So, yeah.
So, in fact, if you look for the month of June, we improved upon. If I look into it sequentially from the month of May, on a YOY also, if I look into it on a quarter-on-quarter, what we normally measure on the Q3 basis, there also we have seen some improvement over there. As I said, had the north would be doing better for the industry and definitely for Voltas, probably would have seen good amount of improvement in market share for the Voltas as such. So this is where it stands. If I look from the industry perspective, you're reading this perfectly all right. Industry has not grown in the volume. The growth is there, but what the data we are getting from all our industry players and from the market, it is lower than single digit.
Okay, and this is on pricing.
Sorry.
Yeah, and just on pricing, any change in competitive behavior from any of your peers? If I can name some like Lloyd, Daikin, who've obviously become hyper competitive over the last few quarters. Any change there, or is it still very, very volume focused over margins?
Ankur, and we all know that if the initial months of the season quarter won't perform in line with the growth which company has projected or the brand has projected for, the only tool what they have is to resort on the pricing. So we did see aggressive pricing by few brands. You name almost all, so I'm not going to put again to save time on the Q&A session. So that we have seen it, but as I said, we won't concentrate only on the price because there are certain tools in our hand which Mr. Verma in his opening spill has clearly spelled out on which we focused upon it. It will be circulated to all the investor fraternity as well. So I would say that rather on price, we have more focused upon the BTL activities and winning the confidence of the channel partners on some of the markets where we were focusing upon for a long time. And that has helped us. And as I said, we have to continuously drive this as we move forward to achieve our strategic goal of market share as well as margin what we are looking for.
Yeah, okay, sir. Great. Got that. All the best. Thank you so much.
Thanks, Ankur.
Thank you. We have a next question from the line of Siddhartha Bera from Nomura. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, you have indicated that in the quarter we have seen some commodity softness as well, and our revenues are also higher on a sequential basis compared to last quarter. So this margin drop sequentially, I think, can you just explain what has been the major issue? I understand that you have not taken any price cuts is what you are indicating, but slightly more color on how to look at the margins from current levels.
Siddharth, in fact, in the past call also when we said why the commodity softening is not going to generally help the industry, the reason being is because looking into the seasonality of the product, generally the raw material gets indented at least 3 or 4 months in advance. And that's why if I can see the announcements, because this time we were late in our announcements of the results, but if I see from the other brands who have announced the results, they have also not seen any significant improvement in the gross margins. This is the prime reason. The softening of the commodity price most have been seen after the February and March, where for the brand as such, or for the almost all brands, the raw material got indented and the material starts flowing it for the seasonal purpose. Now, having said that, your valid question is the sequential drop in the margin. If you recollect, during our March investor con call and thereafter as well, the brand incurs substantial amount of advertisement expenditure during this season period. And it goes, if I look into advertisement expenditure, if I look into quarter as a percentage, quarter revenue to quarter outflow on advertisement, it goes as high as 4%, 4.5%. And that gets settled down once we go down, and at the end of the year, you find we end up doing 3 or 2.75 to 3% of the overall turnover. So that is prime reason that some of the expenditure which are required to go on a supporting the BTL and the ATL activities being incurred, impacting the overall margin on a sequential basis. The question from your side is how should we look as we move forward to the subsequent quarter? We have been telling that the industry is becoming more competitive. Most of the brands are eyeing for the volume. Furthermore, the PLI scheme, if you have to qualify for each of the brand players in the industry, we can see more assortment of the price on account of to drive the volume growth and thereby qualify for the PLI scheme. So in and all, Siddharth, we keep our stand maintained that industry will now come to a single digit margin. None of the players probably will be seeing it going into double digit. And among those, even Voltas will continue to be a leader in the margin. I would not like to quote any percentage currently because we have been telling about the single digit margin, but I would like to maintain the same that rather I would go on that irrespective of whatever happens, the Voltas will remain leader both in margin as well as market perspective.
Got it, sir. Also, for the quarter, will it be possible to share the secondary volume growth which you have seen, or that will be difficult?
No, we can share with it. If I'm not wrong, the secondary growth for the industry in the market, if I take, generally we take, Siddharth, from February or January to June, because that's a period where, because different parts of the country goes into a different kind of trajectory of the season and all. So if I look from the perspective, probably the industry has seen a secondary growth of around 8% if I take January to June. But I would request, wherever we did one snapshot on that, so can you just reconfirm on those numbers if I take January to June and if you take April to June for that matter? Hello. Vaibhav, are you there on the call?
Mr. Vaibhav.
So Jan to June is 8%.
Jan to June is 8%, right, for the industry as such?
Yes, sir. Yes, sir.
Yeah. And that's what I said, Siddharth. So why we took Jan? Because we know very well the summer in the south region starts from the from the February. And probably looks like this year, although we have seen good amount of monsoon during the, I would say, unseasonal rains, but the second summer has already started both in west and south. As I'm sure who are attending from Bombay and all, they are feeling the pinch about the second summer and all. But if I take April to June, Siddharth, so I've given you Jan to June, and if I take April to June period, the growth is around, for the industry is around 20%.
Got it. And the second on this project business, so we have continued to see the recurring losses coming out in the past few quarters. Possible to highlight when we get back to the normal sort of margin levels going ahead, or there are many more such provisions which will keep coming up in every quarter?
Siddharth, you're right in saying that there have been certain collection delays and certain other additional provisions which we have to take. But I will assure you that these are following the conservative approach, which I can't say for other companies, but we, being part of a larger group, we always report whatever is the truth out there. Now, in the project business and specifically in the global markets in the Middle East, there have been certain headwinds with which, when we are looking at our projects business, we are taking those provisions. This is in a way cleaning up of the whatever legacy issues or whatever would have been.
Like even in this quarter, we have reported and we have shown in our financial statement press release that there was an encashment which we will be fighting and we'll be going with that. So I wouldn't say that this is something which will continue, because on the other side, we have also started becoming more and more strict in our order taking, and the orders are many, so that it will not restrict our kind of growth in that part of the region. Though for a year or so, we may step back and look at our procedures and the way we select our partners in terms of who we work with and what kind of contracts we take, and we ensure that we get payments on time. Because when we do our work on time, we expect our payments also to get on time, and we don't want to get in situations that once the work is done, we kind of are pushed or the payments are slow. So that's a approach, or you can say it's a retweaking of the business a little bit, and just taking the prudent approach on the numbers.
Got it, sir. Thanks a lot. I'll come back in the queue.
Sure.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer queries from all participants, please restrict yourself to 2 questions. You may join back the queue for follow-up questions. We'll take our next question from the line of Abhijit Akela from Kotak Securities. Please go ahead.
Yeah, good afternoon. Thank you so much for the opportunity. Just on the UCP segment, I wanted to confirm the number that you cited earlier. I think that air coolers has grown about 49% in the quarter. And if you could also please just share how much the commercial AC and commercial refrigeration parts of the segment have grown, as well as RAC on a pure play basis.
So if I look from the commercial refrigerator perspective, we have put on our screen that what we anticipated the growth actually has slightly come down. The reason being is on a higher volume base at a first step. And second thing is, due to the incessant weather, the demand for the cold beverages, chocolate, and the ice creams actually had tapered down. So once we see this kind of cycle, you find that the demand from the OEMs are not there and impacting the overall primary sales from the brand as such. To put together, our growth in the commercial refrigerator was in single digit. And if I look from the CAC perspective, the product sales actually have done much better in terms of the product sale. Service revenue, which we combine the commercial conditioner, has seen a lower growth if I compare with the product sales. But the overall growth for the CAC business was around in double digits and exceeding 25 to 30%.
Got it. No, that's very helpful. Thank you. And then just the other thing was on the market share numbers. So when I look at the exit run rate of market share reported for June, it seems to be about 20.6%. Versus last year, I think it was 24.1% as of June again. So it seems to be a decline. I was just sort of trying to reconcile that with your statement earlier that market share has actually increased. So perhaps if you could, if it's possible to share the average market share for the quarter, both for 1Q this year and last year.
When I was saying I have improved about the margin, I was more referring to the sequential improvement from the May. If I take from April, or I can take it from March, April, May, June. Yes, if I compare with the last year June on a YOY basis, yes, the market share is down, and we have been trailing into it for the last almost 8 to 9 months. So we have came down from 24% to around 20.6% now in the June exit. If I take an average market share, we are somewhere around 19% as we stand right now. There is no comparison for the last year, because last year we were running most of the year in excess of 24%. So you can say for a calculation purpose, we are running around 24 average market share in the last year, and this year we have came around 19%, what I just told you for that matter. But there is, as I said, there's a journey for it. And that's why I said some of the markets we analyze in much deeper way where we have to focus upon. The efforts are there, and we're hopeful that as we move forward, it turns out to be, in a result-oriented gain in all the efforts what we are putting currently.
Got it. No, thank you so much. That's very, very helpful. Just one last quick thing, if I may slip in. Just a geographical or region-wide split of revenues, if it might be possible to share some color on that for this year versus the comparative last year numbers. Thank you so much.
Obviously, what I said, Chief, that the industry has seen the tilt towards this current year. Otherwise, North normally contributes 50 to 55% of the overall business for the industry, and that even Voltas is very strong, but we cannot be far away from the industry. Otherwise, our market share, we see immediately good amount of fall into that. So in an overall basis, if I look into it, the South has done this time much better. South and East, they've inched up by 2 to 3% what they used to have otherwise. North has dipped down, and West has affected the most.
Thank you so much, sir. Wish you all the best.
Sorry, Abhijit, hi. Vaibhav this side. The market share for Q1FY23 was around 22.5%.
Okay, so 22.5 compared to about 24 last year.
No, 22.5 last year, this is 19% this year.
Oh, okay. Got it.
Average of last year? Yeah, sir. That's the data. Okay, thanks. I was thinking around 22.5.
Thank you so much.
Thank you. We have a next question from the line of Dhananjay Bagrodia from ASK. Please go ahead.
Sir, congratulations on a good set of results. Just a couple of questions. If you see our EBIT for our EMP business, the losses taking in the exception of the last 2 quarters also, has been equivalent to a 5-year EBIT of the same business before that. So net, all the hard work is not being able to be fructified. Is there any thoughts about maybe scaling down the business or even going about it slowly? Because 5-year business to be lost in 3 quarters is a huge number if you think about it.
Dhananjay, what you are saying is exactly the thoughts in the minds of the management are, and that's the fact. I mean, the numbers don't lie. Rather than scaling down the business, like I said, the opportunities are great. You have to go in with, I would say, more improved processes in terms of who we contract with, how we contract with, and what kind of procedures we put in. And those are the things which we have been doing over the last few months, and we continue to strengthen that part of our business in terms of getting the things properly in order. On the execution side, as the project is executed, we are very strong, and we have been in that part of the region for the last 40 years. However, certain players in that part, they have started this new thing of not paying on time, and then once the project is done, then finding excuses for not paying it. So those things which we need to improve. It's I would say it's more external, but we need to be stronger internally to face these kind of external situations. I do not want to name or be specific, but yes, it definitely does not look good that all the efforts of last few years get wiped out in a smaller portion. But at the same time, as a part of the larger business of Voltas, we always stand with our businesses, because each vertical or each segment of the business have their good days and bad days. I mean, at this time, we can say that IOBG is facing some rough weather. IOBG refers to our international operations. So they are facing certain bad weather, and we need to stand with them. So there is no scaling down, but it is prudent cleaning up of the processes.
So from your assumption, having seen other players also do a similar business, what are we doing wrong in this compared to other players? Because no one else is having this EBIT level loss or is recurring. Anything which we are doing different versus them, and then what we can incorporate to do something similar to them?
We are looking at other businesses also, which are in the similar field like us in the electromechanical projects. We have seen people facing similar problems in the business. How are they doing their accounting is what we would not like to comment. And like we have said, that we always take a transparent approach and a prudent approach. So in the business side, we are seeing kind of similar issues being faced by others. Yes.
Okay. And sure. And so would we also look at like how other players have started realizing that to go about the segment by maybe having a outsource model so that to increase our asset turnover? Is that something which we could also look at for our UCP business?
I don't know really what you refer to. I mean, in this contracting business, the outsourcing is a norm. Because
no, sir, he's referring to the UCP segment. So, am I right?
Okay, sorry, I thought you were talking about the project.
I agree. Project is always on outsourcing model, what rightly said by you, sir. So, in case of UCP, what happens generally is asset-light model was the key till such time we have seen, or I would say we have different sources to put the material in. Now, the question is happening is when you go on a higher on the volume side, it all depends upon how you strengthen your background or I would say back-end process in order to gain control on the design as well as on the uniqueness which your product is going to differ. To our reading, when we have gained our market share this time, we could do it by virtue of our in-house skills which are there in the market today in a larger spectrum, and that actually helped us to go on this. We are still following the asset-light model because you know very well we have not gone for the entire backend or the all components getting manufactured in our own factory. We are going to outsource some of these in the to the OEMs and to the import source, but the balancing needs to be done in order to, as I said, the advantage to achieving the product differentiation, design, controls, and more importantly, to get advantage on the shift in the economies which we are seeing today in terms of resourcing.
Okay, fine. Sure. And so any thoughts on what you all think, let's say now this year we've been impacted, for the remaining year, what could volume growth be for, not maybe for you all, but for the industry? Hello?
Was I missed your question?
I think, can you hear me now?
Yeah, I can.
Just a question, what do you think will be volume for the industry for the year?
Oh, you're asking me at the end of the quarter one to forecast for the quarter four. In fact, for the quarter one, the industry was expecting around more than 20% growth, but the way in which weather behaved, all forecasts have come down drastically. So I would say that let's wait for the festival period to get over for us to assess in terms of how the overall volume growth will look like.
Fair. Okay, sure. Thank you.
Thank you. We have our next question from the line of Nihar Dave from Valum Capital Advisors. Please go ahead.
Yeah, so thank you for the opportunity. My question was, since that market share has come down, like you said, on an average from about 22% last quarter to 19% at the moment. Do we have any plans or strategy in mind to get back to that 22 or do we see our strategy aligning more to 19 itself and continuing at 19?
See, as I said, none of the brand would like to stay where they are, and they make all efforts to climb up on the stage, and that's where we are leading upon. Our internal target is on a much higher side, and I would not like to quantify on the call because we have to prove ourselves, which we've proven now in a quarter by improving upon it, and hopeful as we move in the year forward, we'll see a good amount of improvement over there.
Okay. And so my second question is, like you said, the gross margins are also down. Any strategy change that we're expecting that we will start pricing more aggressively like our competitors are to gain that internal target, which is a higher market share?
As I said, we always try to balance the market share and the margin, and we'll continue to focus upon it. That doesn't mean that no price correction we have carried out in this quarter which has gone by, but that correction was not across the entire market and across all categories or across all SKUs. So we do balance it out, and we'll do that activity, or that I would say eye in detail, which we talk about, and keep our eyes close to the market. So we'll continuously follow, but you won't find any price correction happening across markets and across all SKUs. We balance it out to gain wherever we can and to lose the purse wherever we find it is better to do it to maintain our positions in that particular market, in particular potential territories.
Okay, so sorry, please.
No, I just wanted to add that you have to remember that numbers, of course, everybody looks at the numbers on market share, but we continue to maintain our leadership position both in the market share as well as in margins. See, there are certain players who tend to, buy the market share by continue to keep on making losses in the segment and saying that we have the volume numbers and stuff like that. So we are very alive to that fact, and we have to balance our situation. We are not here to, give away our market share to anybody who wants to come in and play the prices. So we, according to the geography, according to the market space, we are also doing what we need to do on pricing, on other areas, like we earlier mentioned, whether it be in increasing our reach, increasing our, strategies by introducing more innovative products, more value engineered products to save costs, because at the end of it, it's always margin versus market share. And we are focused on our market share as well as at the same time doing if somebody wants to go and keep on hurting themselves, that is their problem. We have to maintain a balance out there.
Got it.
We give you the correct.
Yeah, absolutely. So just a small follow-up on that. So any particular regions or any particular categories that you are, the management is more open to, let's say, being aggressive at pricing?
So I would say entire market is open, Chief, for us to play around on pricing or on the kind of product differentiation. So I would say that focus will be continuing where we have put our efforts on south side. North, anyway, we are strong, so we have to further ensure that we are not losing on that position. West and East required to be more, I would say, aggressive in terms of seizing the opportunity of the growth in future.
Okay, perfect. Thank you so much. Best of luck. Bye-bye.
Thank you. We have our next question from the line of Latika Chopra from JP Morgan. Please go ahead.
Hi, thanks for the opportunity. Two questions. Just trying to understand the construct of your revenue for air conditioner segment. The first is, if you could share what is the salience of organized retail and e-commerce in this business currently versus, say, a couple of years ago? And how does profitability metrics track for these channels for you versus the, traditional dealer channels? That's the first question. And the second question is, again, just to sense, what is the contribution of channel finance, to this segment currently? Is it very different from what you saw pre-COVID? And also, does it influence in any way, the trade margins or the product margins? Thank you.
So, Latika, if I were to put on the The first question in terms of how the organized, the e-commerce have behaved. Latika, in fact, the definition of the organized trade is changing, I would say, in a very dynamic way. And what we count with the organized trade, we are counting the regional strong partners as well, because what is happening with them is they are expanding to beyond their home territories. So in our terms, in the industry terms, we talk about the regional players, but they are now taking shape of the organized player as well. Otherwise, if I go to the old tradition of the organized players, I would say I would find the modern trade, which was classifying another organized trade as such. So if put together, both I look into the e-commerce plus organized trade, they are strengthening their position in the market, making it difficult for the mom and pop store for them to survive. And eventually, if retail has to drive to the tier 3 and tier 4 cities as well, probably over a period of time, distribution itself will convert into a retail stream, and you won't find any products are getting or being done through a distribution channel. But that's probably another, I would say, a long-term, or I would say a mid to long-term kind of market development. But otherwise, what we see today is put together e-commerce, organized trade, modern trade, put together, they have inched up to close to a contribution sale of industry around in excess of 20% or 25% compared to what they used to have, less than 10 to 12%, I would say 3 to 4 years back.
And does it in any way influence the channel margins on a like-to-like?
Obviously, Latika, when some becomes more stronger, the monopoly principles drive, right? So it's going to be more difficult for the brand in order to serve the modern trade or the organized retailer, and e-commerce as well. I would find the e-commerce is disruptor in another way, because they do announce one-day sale, a big bonanza sale, and the price gets dropped without even consent from the brand side. So we have to deal with it, and we have dealt in the past with all these nuances, and we will continue to do into it. But what is more is, like, if this are getting more strengthened, it will see overall impact, of course, to serve to the end consumers. And that's why you may be recalling that all brands are now putting more focus on the brand outlets, on their exclusive brand outlets, as well as their own e-commerce portal or the online channel in order to cater to the customers directly. You may not find traction currently, but if I as a brand, if you see the next 5 years down the line, probably this should start getting good amount of attention from the customer as well. In terms of your second question, sorry, I missed out. What was the second question?
That was on channel financing.
Channel financing. So yes, channel financing, yes. In fact, the entire market under the channel financing undergone a change for the last 3 to 4 years. We have seen these small finance companies, credit cards, and all are now getting participated in the consumer finance, seeing this retail growth in this category. And these once upon a time, the stronghold like Bajaj Finance, they are overall losing share into it. But if I want to put a percentage on the leaders, Bajaj is still a much higher percentage or share in this overall market. But the credit cards and all of those also have almost started contributing in around 10 to 12% in the overall channel financing spectrum for that matter.
So what's the total savings of channel finance products in your revenue?
So generally, Latika, you find during season it goes on a higher side. So if I look Q1 sale, for us, I would say that if I want to put as a percentage to turnover, or I would put percentage to the primary, because secondary data we do analyze on an overall basis, it does goes higher as 30-35% now on a channel financing, which otherwise used to have 10 to 15% if I look into 3 to 4 or 5 years back. It is increasing on a year-on-year basis. But as I said, it is not on a totally non-recourse basis. Brand only just contribute towards the subvention cost. And there also we do many times co-sharing with the channel partners, because at the end, entire channel is getting benefit and not along the brand.
Okay, thank you. And just one follow-up. How many brand outlets do you have now?
We are currently around 270, and we have a much aggressive plan to expand into it.
And across how many cities now?
Across, we find more on the tier 2 and tier 3 cities, because there otherwise metro find difficult to have. Although we are planning to go for it, but then more presence you find in tier 1 and tier 2 cities. Tier 3 is yet to catch it up in terms of the I would say market as such.
Sure. Thank you so much for your answers.
Yeah, thanks, Ati.
Thank you. We have our next question from the line of Keyur from ICICI Prudential Life Insurance. Please go ahead.
Thank you. Sir, first question is on this breakup of the UCP segment, either for the season of Jan to June or for the full financial year. What would be non-RAC as a percentage of UCP revenues broadly on a steady-state basis?
So obviously the percentage of RAC will be higher during the season time, because when I say season, in a sense, if I put together CR, air cooler and AC together, the percentage definitely get tilted towards the air conditioner being the large value per unit item compared to the air cooler and the commercial refrigerator. So I would say, like, if I were to go on an average analyzed basis, you find that if I take 100 as a part of contribution from AC, CR and the air cooler, you find that 80% largely comes from, 75 to 80% comes from the AC, 15% odd, 15 to 20% comes from the commercial refrigerator, and air cooler also the volume you find huge on a higher side, but being the lower price per unit value, it contributes around 3 to 4% of the overall revenue, or around 2 to 3% of the overall revenue.
And on top of that, commercial AC would be...
So I have contributed this from considering the 100 as comprising of these three. If I add the CSC, then if the CSC becomes 100, then CNC will contribute around 20% on an overall basis, 18 to 20%.
Okay, understood. So second question on the inventory. Since in a weak season, you have done this kind of great sales growth in UCP, should we assume that channel inventory is normal? So what is the channel inventory and brand inventory levels as of now?
As I said in the answer to the first question to one of our colleagues, that generally primary follows the secondary, because if there is no secondary, then primary also will feel some kind of impact into it. In terms of inventory, if you are looking into, in particularly the sale which took place or which taking place now under the secondary second summer, in our own reading, the inventory at the trade level is a much comfortable level, and probably it will not go beyond even 30 to 35 days if I put together all India basis. Region-wise, it may differ, but I'm sure South and West will not be carrying huge inventory, including East as well. However, the North, because the season has seen some kind of setback, may be slightly having the higher inventory.
Okay. And so just last one clarification on the one of the points in the result press release regarding 3.7 billion bank guarantee being asked by the main contractor. So this is already shown as of now as contingent liability. Since you just clarified it, since it was basically main contractor asked to encash the same. So we don't believe that, so it is continued to be a contingent liability and we don't need provision as of now. That is what the stand is, right?
Yes, that is, you are correct. And that is why we have, it has always been, it's a case actually from many years ago, which has been going on between the original customer and the main contractor. Nothing, no claims on us, no nothing, but at the same time they encashed, they send a request for encashment to the bank, and bank has rightly decided not to encash it. And therefore we have continued to keep it as a contingent liability, of course with a note clearly explaining what is the situation. That stands.
Okay, understood. Thanks a lot and all the very best.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thanks all of you. I think there were some very wonderful questions to get insights into the business. As closing remarks, I would like to maintain that, Voltas is a national brand and we continue to focus on our leadership positions, and we are always there to, provide good products at the right price to the customers, and customers know what Voltas stands for. We are a national brand. We have shown in this quarter that in spite of incessant rains in all of North India, we still do a very strong growth in other regions, other parts of the country. So that's a kind of a testimony to the strengths to which we can draw on. We are looking to grow this business more. The penetration levels in the country still remain low, and we are, going to get the fruits of the economy growing as our current government has very aggressive plans for Make in India, and all those benefits will definitely accrue with the company, and we will continue to go for it. We are expanding. We are making the factory in Chennai. So that definitely is an indication that we are out there to make the most of the opportunities which are being given to us. And with that, I'd like to thank everyone once again.
Yeah, just to add on what Mr. Verma said, but this year is going to be challenging for both product and the project business. And the efforts from the management side is to continue this growth momentum and seize the opportunities whenever it arises in the future. Now, having said that, guys, I know we could not be answering to all the questions from the investor side. We are open for any Q&A session, but my only one request is, since I have some personal commitment on this next 2 or 3 days, if you have any questions, I will be able to answer them post Independence Day or post 16th of August. In the meantime, if you have any pertinent questions, you can reach out to whoever. My call may go on a silent mode because of the personal commitment that I have. Thanks a lot to all of you to spend time on the weekend to attend this investor call, and wish all of you a good weekend and extended weekend as well. Thank you.
Thank you. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.